thoughts. And this is 4 factors that increase the chance of losing money in investment fraud. Remember we told you in insurance, ignorance is a covered peril. In investments, it's not. Boy, I've known people who have spent years building their investment portfolio and they've lost a good chunk of it due to poor decisions. And most of it's poor decisions on their part. So what are the 4 things? Number 1, not recognizing who's most susceptible to fraud. Who are the people who are most susceptible to fraud? Is it elderly widows? Is that the biggest one? Do you know what research has found? It's married men with above average intelligence who are also financially literate. So who are the people that are most susceptible? We are. 2, trusting enablers. The term trust me is the single most important ones. You know, sometimes it's stated explicitly, sometimes it's implicit. Generally, they belong to the same church, the same workplace, the same community group or neighborhood. So realize that affinity fraud is a huge part. Number 3, being greedy. It is said that an effective con artist will never try to convince a skeptic. Skilled crooks focus on persuading investors to believe what the investor already wants us to believe. This is an interesting fact, too. Division has noted that the higher the promised profits, the less effort investors will make to check it out because the investors want to believe it's true. Number 4, not recognizing the red flags. Some statements always signal fraud, no risk, guaranteed, double your money. You know. But the point here is we need to understand who are the biggest, what's the biggest concern, and it's us. You know, what did Pogo say? He said, I have seen the enemy, and what? He is me. And you know what? And that's the truth. So we need to be wise on what we do. Again, I got this from the Better Business Bureau. They give just 3 suggestions. What can investors do to protect themselves? Question 1, just ask these 3 questions. Is the person offering the investment licensed? You can call the securities, Division of Securities, and anyone who's selling securities in Utah must be licensed. Number 2, is the stock offering registered? All securities sold in the state must be registered or exempt. Again, called the Division of Securities. Number 3, did the promoter give a written prospectus summarizing the investment? You know, if you don't, you know, you can be sure it's a fraud. Okay, let's talk a little bit about what we're doing today. Again, what we're going to talk about is, now we're going to talk about how do we build that portfolio. We've talked about, you know, kind of building the priorities. We talked about what are the principles of successful investing. We talked about building an investment plan and what are our risk and return objectives and our guidelines. And now the question is, how do we build a portfolio? And that's the important one today. And so on the section on stock basics, what we want to do is I'd like you to just review the risk and return history for stocks. And just kind of go through those PowerPoints. How have stocks done over the long term? Second thing I'd like you to do is I need you to finalize your preferred asset classes. You know, we already had your equity and your bond allocations, and now what are your asset classes and equities? Large cap, small cap, international, emerging REITs. What are those asset classes there? Then on building your portfolio, want to make sure you understand the difference between investment assets and investment vehicles. You'll determine the size of your emergency fund. And now what we're going to do is we're going to divide the asset classes between our taxable and retirement accounts. And you'll finalize your asset allocations, and then you'll transfer this to Teaching Tool 13. So someone's hidden the remote. Okay. So these are the things that we're going to be working on today. You know, we laugh and we get a kick out of things like this because we sit with 20/20 hindsight. But we need to have to be wise about this. You know, a lot of times in those 4 things, greed, you know, affinity, those things really come in and have an impact. I have this, I had this little figurine at home. Last time I brought it to class, I actually broke it. So I had to take it home and think. But it says this, it says, God grant me the serenity to accept the things I cannot change, the courage to change the things I can, and the wisdom to know the difference. How would this figurine relate to investing? Yeah, so we should focus on the things that we can change. What are the things that we can't change? Yeah, we can't change the returns, but what are the things we can change? So there's 6 things that have an impact on our investments. 5 of those things are the things that we have control over, and 1 of them we don't. And the one thing we can't control is investment returns. And the interesting thing is the novice investors are the people who spend the most time on the things they cannot control. So what are the things we can control? What can we control? Go ahead, you were saying?
Yeah, like asset allocation.
You can control your risk level, which is asset allocation is how you control your risk. So we can control our risk. What else can we control?
How much we save.
We can control how much we put in every month. We can, well, that's our risk level. We control our asset allocation. So how much we put in, we can control how long we keep it in. Okay, so how much we put in, how long we keep it in, we can control our asset allocation. What are the 2 other things that we control? We control our taxes. By the types of investments we choose, we determine how much taxes. So we control our taxes. And what's the last one? How about the fees we pay? By our choice of assets, does that have an impact? How much you save, how long your investments go, your mix of investment, your asset allocation, or your risk level, how much you pay in expenses, how much you pay in taxes. So what we want to do is we want to spend time working on the things that we control. And then the things that we can't control, there are ways that we can kind of help that out as well. What I thought I would do today is I'd like to just do a bunch of case studies. Our purpose here is to say, how do we build a portfolio? So what I've thought is what we'll do is do case studies, and the case studies will lead us into some discussions that I think will help us to understand how we build that portfolio. So let's start with our first case study. Okay, Susie's 25, makes $50,000 a year, 15% federal, 7% marginal tax breaks, and expects her tax rates to increase in retirement. 401k that matches 50% up to 3% of her salary. Her goal is to save 20% of her salary every year and put all 20% or $10,000 away into retirement. Which investment vehicle should she use and why? And how much did she save considering savings, company match, and tax savings? Is this a concern you guys will have? And the answer is yes. So the question, are there rules of thumb that we could use to help us to solve this type of problem? Give me some ideas. What recommendations? Scott?
I recommend she just take everything she can that her company's going to match for her 401k.
Okay, so what's her first priority? It should be free money. It's funny, I heard this thing on the radio that says, oh, you should take all of your money out of your 401ks and your retirement vehicles and buy this cash value insurance product. I was listening to KSL on Saturday. That's what they're recommending. So it's kind of an interesting thing. So first priority is free money. Yeah. Okay, what would you do second?
Then she'll probably want to look at different ways that she could find different asset classes that will decrease her taxes.
Okay. So So any asset classes that will decrease her taxes. So really kind of tax advantaged money. And the third one is more tax efficient and tax efficient investing. Skylar.
Well, should she invest in the 401k that she pays taxes on now? Because she thinks she'll be paying high in the future.
Now the question here, she expects her tax rates to increase at retirement. What's that piece of information? Why did I throw that into that case? Right, so the question is, does she go a traditional or a Roth IRA? And so if she expects tax rates to increase in retirement, then which vehicle is better? The Roth is a better vehicle too. So let's kind of go through and let's talk a little bit about the priority of money. And what we want to do well, let's define what's the difference between an investment vehicle and an investment asset. Someone want to define an investment vehicle? Go ahead, Elliot, you got to get ready to talk.
Well, investment vehicle can include different investment assets.
Okay, so an investment vehicle, well, can an investment vehicle have lots of investment assets in it? And the answer is yes. So thoughts on what an investment vehicle is? Josh?
Just like a class of investments, like a bond or a stock.
Okay, you're thinking of an asset class. 2 weeks ago, I took my daughter, and she goes, Dad, can you take me up on the street on the ATV? And so I put a rope behind the ATV, and she hopped on her skateboard, and we pulled her up the end of the street. And then she sat on the skateboard and rode the skateboard down. But I've got a couple of ATVs. One is a 700 that has a blade on it that I used to push snow. And one is a little 80, little Suzuki 80 that my kids like, especially on the ice. They'll come down the end of the street. They'll lock up the brakes, they'll turn it, and they'll pinch it, and they'll just spin like this on the ice. But an investment vehicle is just like the frame. It's 2 wheels, 4 wheels, and then what you put in it is more like the engine. You can put a very high-powered engine, a 700 on it, or you can put a little dinky, 80cc engine in it. Another example, an investment vehicle is kind of like the shopping cart. It's what you go around, and then the investment assets are the groceries you put into that shopping cart. Lots of different ways to think of it. But I call it an investment vehicle as a tax law-defined framework that's usually named after someone's name or a line of code. It's a 401k, a 403b, a Roth IRA, something like that. Those are investment vehicles, and investment assets are the things we put in stocks, bonds, mutual funds. So the challenge is we want to select the investment vehicles that will give us the highest after-tax, after-inflation return. And the process of selecting investment vehicles is what I call the priority of money. Realize different vehicles have different tax benefits. Some are tax deferred, some are tax eliminated, things like that. But the wise use of investment vehicles will help you reach your financial goals quicker. And that's what's important here too. So different vehicles, one is tax law defined framework, the other are just the securities that go. One is the shopping cart, the other one's the groceries. So just to give you some ideas on some of the vehicles, 2012 you can put $17,000 here, and then there's a $5,500 catch up. Notice that the amounts there are not the same. Okay, notice also too, 401k is tax deferred. We get the tax benefit now. We have to pay the taxes. Roth, you pay the taxes now, but you don't have to pay. You don't have to pay taxes when you take it out, Jaron. No, you can't. But could you put together? Could you do a SEP IRA? Yeah, you can. And notice, can you put away more or less? It's 20% or $49,000, whichever is less.
There's no restriction on how many you can have though, right?
No, I have, this year I'll have a Roth 401k, I'll have a Roth IRA, just those two.
But you could have like 5.
Yeah, and you can have, 1 year you do one, and 1 year you can have 50, as long as you don't don't have more than this per year, you can have a number of different ones.
Oh, but that's the max you can put in.
Right, that's the maximum altogether for that year.
What if you exceed that maximum? Like, what's the balance?
If you, let's say you put 18,000 in, you'll actually have to recharacterize that. Yeah. So you don't want to go beyond that amount. So let's talk about the priority of money. What is the first priority? And as Scott said, our first priority is free money. What the companies are trying to do is encourage you to participate in the retirement plans. So the nice thing about that is, does it cost you anything? I've heard people complain, oh, last year the market went down 20%. Well, the company had a 1-for-1 match. What kind of a return is that? 1-for-1. If you put up 1%, the company matches at 1%. What kind of return is that? That's 100% return. So even if the market went down 20%, you still did well. But so the first priority is free money, and part of that is company money, and part of that is money through tax benefits. For example, a 529 plan, or for example, in Utah, if you contribute to a 529 plan, you can deduct 5%. You get a 5% tax credit of what you put in against your Utah taxes. Is that free money? The answer is yes. Now the risks, you have to stay at the company a certain number of years. You have to find out what your vesting period is. 529 plans, you have to use it for qualified expenses. But the point here is we've got those benefits here if we'll use them. Second one is tax advantage money. There's really two types here. One is tax eliminated, or two is tax deferred. And so tax eliminated says you eliminate all future taxes. So if you put money in a Roth 401k or a Roth IRA now, you pay the taxes now, but when you take it out at retirement, you don't pay any taxes here. Also, with a Roth vehicle, after you've had it in a certain amount of time, let's say you need some of the principal, some money, you can actually take the principal out without taxes because you basically already paid taxes. The risk, you can only get it after age 59 and a half without taxes. And education money has to be used for the qualified expenses. Scott?
I had a question about Roth IRAs. Like my wife is working, she's been at her job for 4 years, she has a Roth IRA.
Okay.
And we're going to be leaving this fall, going down school, we're going to be gone, she might not ever work again. What do you do?
You have two options. Number one, you can keep it in the plan, or you can open up a rollover IRA, Roth IRA, and then transfer have the custodian transfer that from her plan to your rollover IRA. And so, the nice thing about that rollover IRA is you get to decide where that money goes. So, still a good thing. Keep it in there. Don't spend it. Okay. Second one is tax deferred money. So this is money that's invested before tax, principal and earnings only taxed at retirement. What's the downside of this type of money? Yeah. Yeah, and also we put it in for 30 or 40 years. What are most of our earnings? Capital gains. What happens when you pull it out at retirement? Instead of paying capital gains taxes, what do you pay? Ordinary income taxes. So realize with these type of money, if you take it out before retirement, you pay a 10% penalty, and then it's taxed as ordinary income.
So when they say that before retirement, do they say, is that before 59 and a half, or do you actually have to not be working?
No. You can take it out after age 59 and a half.
Aren't there exceptions as well for like a house?
Right, so the first house you can take up to $10,000 out without the penalty. You still have to pay the taxes on it. And then also with the Roth, you can take up to $10,000 out without taxes. And then the third one is tax efficient and wise investing. How do we invest tax efficiently? You know, we talked about those principles and things like that. Any thoughts on how we invest tax efficiently? Give me some ideas.
You don't buy, you buy and sell short term.
Right, so invest long term. Other things.
Use appreciated securities for
Yeah, you can donate, pay your charitable contributions with appreciated securities. You can use that to rebalance your portfolio. Yeah, use 529 plans for education. Let me just share some ideas. Number one, know the impact of taxes. Remember, it's not what you make, but what you keep after taxes and inflation that makes you wealthy. Number two, defer earnings to the future. You can contribute to a qualified retirement plans. You can try to get earnings in the forms of long-term capital gains. You can invest with a buy and hold strategy. You don't trade in taxable accounts, and you try to hold assets for a long time. You invest in your 401k and other assets. Number three, turnover in taxable distributions. I used to manage money. I was a money manager, and I didn't realize every time I sold a security that every one of my mutual fund shareholders had to pay taxes on that. I created a taxable event. So when you pick your mutual funds, pick mutual funds that do not trade a lot, because every time they trade, they create a taxable event for you. Because mutual funds are pass-through vehicles. So how do you do this? Utilize a buy and hold strategy. Do your research and investment in mutual funds that limit trading and distributions. Let's talk a little bit about the impact of taxes. So we've got two funds. We'll just say two funds. They're both bond funds, but one trades a whole bunch, and one does not trade a bunch. So here's your beginning net asset value. Short-term distributions. Remember, mutual funds are pass-through vehicles. So which of these funds traded more, A or B? Which one bought and sold a whole lot more? B, because these funds are required by law to distribute to the underlying shareholder 95% of all earnings and capital gains. So what was the return for both funds over this time period? And how do we calculate that return? So here's your beginning net asset value, here's your distributions, and your ending net asset value. And I'll give you a hint, both funds had the exact same return. What's the return for each of those funds? 10%. How did you get it? So you take your ending NAV plus distribution minus beginning NAV divided by beginning NAV. So we had a 10% return. We could also do 10 cents distribution. So this is realized and unrealized divided by 10, and this was 90 plus 10. However, which of those had the higher return, the after-tax return? And well, let's just use this. We'll say, I'm just giving you an estimate of turnover. We'll just assume 35% tax rate. Notice, do you pay the taxes on the realized or the unrealized gains? Only the realized, only the distributions. So this person paid 3.5%, which is 10 cents times 35%. This one paid 31.5 cents. Notice our after-tax return here was 9.65, and the other one was 6.85. So my point here is, even though they both had the same nominal return, on an after-tax basis, the impact of the taxes and transaction costs and turnover can be substantial. So if you really liked Fund B, where would you put Fund B? What kind of an account? A taxable or a retirement account? Yeah, you put it in a retirement account. Okay. And then you place interest income with stock dividends. The reason being is interest income is ordinary income, and it's taxed at the higher rate. Stock dividends are at a preferential rate. And then you could also invest tax-free. You could invest in municipal bonds. You could invest in treasury bonds, which are state tax-free. We talked about EE or I bonds, which are state tax-free, and if you use them for education, they become federal tax-free as well. So a number of different things, but the point here is what I want you to do is think about it. Okay, what's our first priority? Free money. We need to make sure that you're square with the Lord. We need to make sure you have adequate health and life insurance. You're out of credit card and consumer debt, and you have a goals in the plan. But the first thing, we want to make sure that we follow our priority of money first. And then the question is, how do you prioritize investment vehicle choice? And here's what you do, is you take your highest priority money first till you've used up that vehicle, and then you go to your second highest priority money, and then your third highest priority there. Question, where do you put different types of assets? Back to our example on the bond fund, maybe you really like Fund B. Maybe you really like that. Where would you put it? They like to do a lot of distributions, you know what? Put it in your retirement accounts. If you want to trade actively, not that I recommend that, but if you want to do it, trade in the places where the impacts will be felt the least. So if trade actively, retirement accounts, taxable bonds, high turnover funds, put those in your retirement accounts. Your taxable accounts, you want to do mutual funds with a buy and hold strategy, tax-free bonds and things like this. Why doesn't it make sense to put a tax-free bond in a retirement account? Don't we already get the tax benefits there? Yeah, we do. Okay, let's do another case. Susie, Bill, both did master's degrees. They're square with the Lord, out of credit card debt. They still have student loans outstanding. They know their goals, but they haven't written an investment plan. Again, they're still saving 20%. Now we've already talked about investment vehicles, but now what? Now let's talk about investment assets. What should they invest in first? And what should they invest in second? And what should they invest in third? And is there a framework to help us to understand how to invest? Thoughts? What's the first thing we should invest in?
Isn't the first thing like making sure that you have your emergency fund?
And I say emergency fund and food storage, but this is not a food storage class. But you'd start with your emergency fund. What would you do next? Once you had your emergency fund, what would you do next?
Like slowly move to the more risky and higher return assets.
So more, and okay. So what would our next thing to be? Okay, your bonds would be your emergency fund, because when you're first starting out. Let me just, yeah. So are there elements of a successful investment portfolio? And that's kind of our framework. What do we want to do? We want to try to find a way to build a portfolio. And you know, and we understand about CAPM, and we understand about all of these things out there, and we understand about all these finance formulas. But when even the finance professors have a challenge building their portfolios, and when the finance professors don't beat the benchmarks, are there things that we need to kind of lean back on? And I think here's where we use wisdom in what we do. We try to understand the principles, and then we use those principles to build the portfolio. And so as I've reviewed the principles and successful portfolios of the past, there's a pattern. And the pattern is this, and I call it the bottom of the investment hourglass. So we talked about what's the first thing we invest in? Kind of our basics, emergency fund and food storage. So this, when we're first starting out, that really is our bond allocation, because that's the first thing. What do we invest in next? Notice next what we do is we separate our assets into taxable and retirement. Why don't we do that down at the bottom level with the emergency fund? Do you want to have to pay a penalty every time you take money out of your account? Right. So we only have taxable assets here. So our first stage is really our emergency fund. Our second stage is what we call a broad market index fund, or ETF. Of our equities, what's our least risky asset class? Basically large caps. Once we have exposure to that, again, we do the same thing here. Now what I call We want to diversify. We want to broaden and deepen our asset classes. So we have large cap exposure here. What do you think it means when it says we want to broaden our asset classes? How would you broaden an asset class? So we've got bonds, which is our emergency fund here, CDs, things like here. We've got large cap stocks here. How would you broaden your asset classes? And with what could you do that? Pardon me? Yes. So you could do emerging markets, you could do REITs, you could do international, you could do a number of things there. So you're broadening beyond your core market. How about to deepen your asset classes? So here's large cap US. How could you deepen your asset classes? How about small cap? Things like that. And then at the end is your opportunistic individual stocks and sector funds. Why do we include sector funds up there? What's a sector fund? It's a group of securities that are very similar. It might be financials, or it might be utilities, it might be energy. Had a student who was my TA, wonderful guy, he gave me permission to share the story. He got married and someone gave him $3,000. And they had this extra money and he thought, oh, okay, I know what I'm going to do. So he talked with his spouse and they went through it. He went on to Morningstar and he found the fund that had the highest return over the previous 5 years. And it was a, it was a technology fund. And so this was just before the dot-com boom. So they put all $3,000 into this technology fund. And about a year and a half later, it was worth about 40% it was because technology tanked. And what he did, he did everything that we talk about right, except one little thing is he didn't realize here. Now, first of all, do we have to buy individual stocks? No. You know, in my portfolio, and I did asset management for 13 years, I don't have individual stocks in my portfolio. There are mutual funds, and some of those are funds that I pick the mutual funds. Most of it are basically indexed. But the key is stage 4 is only for those who really want to do it. And my only advice is if you really want to do it, just compare your performance to benchmarks and make sure you're adding value. Yes?
What is the difference between an index fund and an ETF?
Okay, what's the difference between an index fund and an ETF? An ETF is an index fund, but that trades at all points of time during the day. It can trade throughout the day. An index fund only trades once a day. Generally, there's a couple of more differences. Generally, index funds, with an index fund, you can, if they're no load, you can buy and sell without costs. With an ETF, you actually have to pay money each time you buy it and you sell it. Generally, expense ratios are a little bit lower for ETFs than they are for index funds. But they're basically the same thing. If you look for Vanguard, S&P 500 index fund and S&P 500 ETF, they're exactly the same vehicle.
So with that student that did the 2,000 straight to the top, and the technology fund. So you're saying that obviously he should have started with the bottom.
He should have started. He should have. I think he had some of his emergency fund, but he probably should have kept it there, and then he probably should have.
So let's say he had the 3,000 option at the bottom 3 levels.
Okay, then you're probably okay.
Okay.
If he already had it, but he didn't. So once you have exposure to your markets, and once you've broadened and diversified, you've got a diversified portfolio, then would it be okay to go and spend a little bit of money there? And I don't think there's anything wrong with it. In my asset management class, we call that education. You're learning about stocks with that purchase here. So if we talked about the top of the investment hourglass, remember we did that, those 4 questions? How does put our priorities in order? What does the bottom of the investment hourglass teach us? What does the bottom of this teach us?
Priority of where to invest.
So a priority of where to invest, and how do we make that decision based on what?
The order, the first one first.
Okay, so the order, the bottom, there's a point here that I want to make. Which is your least risky of all of these stages? Is that your emergency fund? And then what's your next least risky? Large cap in your next least risky, broad and diversify. And so what it does, number one, it helps us keep risk in perspective. Our least risky is the bottom. Then as we get a little bit of experience and get our assets, we're willing to take on a little bit more risk. And then we can take a little bit more risk. Number two, it teaches how to invest it. You invest first in lower risk asset classes, then move up to more risk as your assets and your investment experience increase. Do you have to do that? Do we have to just, I recommend you all fill your emergency fund first, but then do you have to just fill your large cap and then your small cap and then your thing? Or could you be diversified? Could you buy all of them all at the same time? Many of you, you'll go to a company and you'll have your 401k and they'll say, how do you want the allocates, your investments allocated? And you might say, I'd like 40% in large cap, I'd like 20% in small cap, and I'd like 20% in international, and then 10%. So you can actually do it at the same time. But the final thing it does is it separates out taxable and retirement accounts. And the reason being is that retirement accounts have to be managed differently. Because you can't take the money out, or without penalty, you have to be wise in what you do. So ideally what we do is we build our investment plan, we think through. Taxable accounts, what do we put there? Low turnover, low cost, low distribution mutual funds. What do we put in our taxable accounts? If you want to have something that trades a little bit more, you can put those there. But we need to be wise in what we do. Let's do another. So another case now, married, one child, earning $60,000 a year. So they basically got the top of the investment hourglass. They've gone through the plan, they're building their plan. They're aggressive investors, want 3 months of income as an emergency fund, and determine their asset allocation is 75% equities, 25% stocks and bonds. Is that pretty consistent? And so what they've done also, they've divided out, okay, they've also come through, they've given themselves targets. Well, of that 75% equities, 55% is large cap, 10% is small cap, and 10% is international. How should they build their portfolio? So do you see what we've done is we've started by helping you figure out your risk level, helping you understand what type of an investor you are. Then you've actually come up with your preliminary asset allocation. And now what they're doing is they're finalizing their asset allocations. Now again, what's the T and R here? Taxable versus retirement. How do you determine that split? To a degree, it's what vehicles are available to you. But most people right now, when you're first starting out, you could probably put more in your retirement accounts than you probably will later on. But you could just do 50-50 for right now. I mean, you'll refine that over time. But how should they build their portfolio?
Brother Sudweeks?
Yes.
I'm a little bit confused on the split between the taxable and
Okay.
the retirement. Can you just go over what that split is? I don't understand.
Okay, so the process of building a portfolio, we need to handle our retirement assets differently. And so some of the money you're saving, for example, some of the money I save for my kids, I put in retirement accounts or, basically retirement, I should say retirement/education accounts, where I actually have some tax benefits. Because I can't take that money out without a penalty and without taxes, then I have to manage that differently. So as we build our portfolio, for each of you and your families, you're going to have some short-term money for your emergency fund. You're going to have some longer-term money for retirement. You might have some medium-term money for some kids that are going on missions. You'll have some longer-term money for education for your kids. You're going to have even longer-term money for missions and retirement for yourself. The point is our overall portfolio, even though we have a whole bunch of individual buckets of money, our overall portfolio should match our risk level. So I've got some short-term money. Again, my daughter just got back from her mission. So we're going to need, we've got some money we're going to need in about 3 or 4 months. I've got another son coming back in 6 months. So our portfolio should be managed there. But we need to decide how much do we need in the retirement side and how much are we going to need in the taxable side.
Okay, so it's kind of like money that the retirement is money that you're tying up that you're not going to block because there would be a penalty.
Correct.
And then the taxable is maybe money that you use
Right now.
sooner.
Right. So I still have, 4 daughters, weddings. Hopefully they're not going to be in the next, so in the next 5 or 6 years. But I mean, is there any tax benefits on saving for your daughter's weddings, or things like that? And so what we have to do is we have to pull that out. Now that decision of how much to put between taxable and retirement is an individual one, and you'll refine that over time. When you're first starting out, you can put 100% of everything in retirement because you don't make that much income and the limits are higher. As you get older, your incomes will be higher and the amounts that you can put away are a little bit lower too. So just kind of be wise on that. So let's talk about how we build that portfolio. Again, we call level 1. Here's where your emergency fund and your food storage. Again, this is not a food storage class, so we'll let you worry about that later. But it is important. So what would you put in your emergency fund? What kind of assets would you include? CDs, savings, checking, money markets, short-term T-bills, CDs, short-term bond funds, any of those things here. And this will be it. Realize that your emergency fund is really your bond allocation. Okay, so that's our first thing. Our goal is to try to beat inflation and stay ahead of taxes, although it's a challenge. Our objectives in this phase here are just, so that's phase 1. With phase 2 now we've got our core broad market. This is our large cap, U.S. large cap. Let's say you're from Hong Kong. What would your core there? Would it be U.S. large cap? No, it would probably be Hong Kong large cap. Or if you're from China, probably the largest equity markets there. It's from your market. But here, what you want, broad exposure to the least risky of all the equity asset classes. So in the taxable side, some type of broad market index fund. And I give you some ideas, some low fee, under 30 basis points. And actually, probably a better would be under 20 basis points. Something like a Vanguard or a Fidelity or a Charles Schwab or any of those funds there. So what you'd do is you'd put any new assets into this broad market fund. In retirement, it'd basically be the same thing. It might depend on what your company retirement plan has. But you might ask them, do you have an index fund, kind of a broad market index fund as well? Our third level, we want to diversify. Now what we want to do is we've got bonds and we've got large cap equities. Now what we want to do is we want to diversify beyond those asset classes. Now we might bring in international. We might bring in real estate. We might bring in international bonds. You might bring in emerging markets. To deepen, you might do small cap. You might do mid cap. You might do large cap growth, things like this. The point here is you need to figure out what those things are that you like. And let's say you don't like international. Don't invest in it. Our goal is to build a sleep well portfolio. And so what we want is diversification, but we don't have to invest in things that you don't understand or you're not comfortable with. Also, let's talk, you might not understand much about international. But if you bought an international, for example, there's the Vanguard, it's basically a total international index fund, and it has like 7,000 stocks. How much do I have to know about 7,000 stocks? I don't have to know an awful lot. So if I buy a fund that has a whole bunch of stocks in it, like 5,000 or 7,000, I really don't have to know much about it. All I just have to do is believe that over time that those stocks will do okay. And history has shown that. So be wise there. And then the last one, well, here you'd purchase, again, broader asset class, international bonds, emerging markets, real estate. You would deepen small cap, mid cap, value growth, things like that. And then the last one is just, here's the sector funds. And realize, even with all my experience, I don't have anything in this. So the key is what we're trying to do is we're trying to diversify and we're trying to build that portfolio. What I'd like to do now is each of you are going to have to do Learning Tool 13. And so I thought what we'd do is we'd kind of go through and just kind of show you how it works. Because what the investment process worksheet, what it does is the purpose is really just to help you to figure out where we need to invest and where does the money go. So if you've got 4 to 42 assets or 4 to 10 assets, most of you, I think 4 to 10 will be fine. And so notice here's my hourglass, and this kind of explains it. So what we want to do is we want to go, here's our phase, here's our asset class, here's our benchmark, and then here's our allocations. So let's start. Can I get a volunteer to help me put together this asset allocation? Gavin, thank you for volunteering. Okay. Okay. Now the question is, how do you figure out how much do you have in your emergency fund? Any thoughts on that? Okay. So Gavin, give me any number you want. So we just use 50,000 here. Okay. And so they like between 3 and 6 months. So your emergency fund should be somewhere between 12.5 and 25,000. How much do you want to put there?
Let's go 15,000.
Okay, 15,000. Now, let's start with your emergency fund. What were you on your risk tolerance? Aggressive. How old are you right now, Gavin? 24. So if you're aggressive, you would cut your bond allocation by somewhere between 5 and 10%. Should we just use, what are you planning for your bond allocation? Okay, how about if we just use 15 for the math? Now notice, if I take this 15,000 divided by my 15%, notice it gives me an initial target portfolio of 100,000. And then notice if I take that 100,000 times 15%, this is my first goal. Now, I did it this way just to make it easy, because I'd like my first goal to be my emergency fund. So in Gavin's case here, what he's going to do is he's got 15% in his bonds and cash. And this is his emergency fund. Now he still has He still has 85% now. So let's continue. You mind if I go through? So you're aggressive. So generally, for most people, I would say over half of your equity fund should be in your large cap, just because it's the least risky. Now, if you're aggressive, you might want to do a little bit less than that, but something like that. What percent are you going to have in large caps? 40%. And how do you want to split that out? You want to do just 20 and 20 for right now? Yeah. Okay, so now we've got 55%. Now you've got 45% more to split. Notice now that it tells you here, okay, our target portfolio, 20,000 of that's going to go in taxable, 20,000 of that in retirement. So we can actually get a sense here. What other asset classes do you like? Do you like small cap?
Yeah, let's do just 20%.
Okay, you want to do 10 and 10?
10, yeah.
How about, do you like international?
No.
Okay. You like real estate?
Yeah, let's, how much do I have left?
You have 25 left.
Okay, that's going to be hard to split. We'll just do 25 now, just 12.5.
Okay, now real estate, remember you're going to have a house. And so how about if we do, yeah, well, how about if we do 10 and 10 and, maybe do 5 there. But now do you notice that what this did for us, it helped us to figure out where does each of our allocations go. And now notice, so here's our phase, here's our asset class, here's our benchmark. And now what we're going to do on Thursday is we're actually going to go through and pick the funds. Now what this spreadsheet does, this says, okay, this is our goal. And now let's say Gavin's working, and after a year he's got 5,000 here. And he picked this fund here. He's got 3,000 here and 1,000 here and 1,000 here. So first one is our plan. This is where we are. Notice this is what we still need to buy. Notice up here we had 15,000. He's already bought 10. Or he's already saved 5. So now on this one here, it tells us what we still need to buy. And so that's what this investment process worksheet does. So our point here is, how do we build that portfolio? We start with emergency fund. Then we go core exposure, emergency fund, which is bonds and cash. Then we are our next least risky asset class, which is large caps. Our next risky, which is kind of diversify, and then our most risky individual ones there. So let's continue. Again, we've gone on. Now they're making 80,000 a year. The financial house is in order. They've got their emergency fund. They've determined the same asset classes and benchmark as they did before. Now these are their holdings. They've got a savings account. They've got an index fund, a small cap fund, and an international fund. So their original goal was how much? Wasn't it like 60,000? Did I miss that one? Let's go back to this one here and let's take it through. So the first thing they had to do was determine their initial target portfolio size. And so what we do is we take the 3 months income divided by their allocation to bonds and cash. That gives them 60,000 as their initial target portfolio size. So everyone in this class could have a different initial target portfolio size. Second thing we do is we take their asset classes. 25% times their 60,000 gives them the 15,000. Realize it'll always produce your target emergency fund goal. And that's just kind of the way that I set up. We'll divide out their core, 55% gives us 33,000 in large cap, 6,000 in international, 6,000 in the portfolio. And then what we do is we kind of divide those out too. We know what percent goes to taxable, and we know what percent goes to the retirement account. And then here's kind of what their portfolio looks like here.
It's kind of not really off topic, but so in most of these examples are young, 25 years old, just out of college. Where would they be saving for the down payment of the house? Where would that?
Generally, what I'd like to do is I'd save for your down payment outside of your 20%. And truthfully, you guys can decide. Where would you put your down payment on the house? How soon are you going to need it? Pardon me? Probably not 5 to 10 years. Probably 2 to 5 years. And you know what? If you and your spouse decide, or if you decide that that's where you want to do it, you know what? You could do that too, because they're your goals. They're not my goals. But my recommendation is once you get in the house, don't put all of your money just paying down the principal. Make sure you're investing at the same time.
To me, it seems like saving 20% for a house is not a lot of money to save at any short amount.
Okay. And you may need
it's really hard to put.
Yeah.
Money and health is different.
Yeah. And you're right. And if that's a goal that if that's your goal and you feel good about it, then do it. Again, with all of these things here, I'm teaching principles and giving ideas, and you guys will apply those to the best you can. And then once they have that allocation, they would research their potential candidates. select the assets, and then they would add those to the portfolio. Okay. And then to compare it to the target portfolio again. So now we're going another 10 years. Remember, 60,000 was their initial portfolio. Now they've got 75,000. Their initial portfolio was 60,000, and now they've already saved 75,000. What do you do now? What do you do now? Should they sell? Is that a good thing to sell funds? Thomas, what do you do now?
Well, I think what I would do is I'd raise
Raise your target portfolio size.
raise everything a little bit, but probably put a little bit more in the small, in the more risky stuff.
And that's exactly it. What do we do now? We just figure out their new target portfolio goal. Let's say their current one is 60,000. Well, here's what you do now. Once you hit the goal, if you're married, you and your spouse, you do something really fun because you hit a really important goal. You know, go on a cruise or do something fun like that. And then you start working on your next goal. So you'll raise it. Before it was 60,000, you know what? You might want to kick it up to 80,000 or 200,000. Now notice, with their current salary of 80,000, their emergency fund should be 20,000. Their allocation for bonds and cash is 50,000. So now they're going to have to figure out something to do with the other 30,000. And so now what we'll do, they'll purchase an additional fixed income securities. They might want inflation linked. They might want to do a junk bond fund. Of course, right now I don't think that's probably a good idea. Might want to do a short-term bond fund. But realize once your emergency fund, you have that sufficient, then any new bonds and cash will be different asset classes. So determine new asset classes and their target percentages. Now notice that we have this new one here. Calculate in each of the areas here, and now work on exposure there. So what we've given you is a process of determining how do we build a portfolio. And ideally, this portfolio should be a sleep well portfolio that we can, that no matter what happens, we can still sleep well at night. We're not worried about what happens, in the individual markets. We've got our emergency fund. And then once we hit our target portfolio size, whether it's 60,000 or 200,000, we throw a big party, we hit our goal, and then we increase the goal. And so investing is really just the process of hitting one goal, then the next goal, then the next goal, and then the next goal. All at the same time, we keeping a diversified portfolio that's consistent with our level of risk. So now what we've done is we've talked about principles. We've talked about our investment plan. We talked about the things our investment plan entails. What are the mistakes that people make, and how do we keep ourselves from doing that? We've talked about how do you build a portfolio in the different phases. What's next now? So we've got our asset classes, we've got our percentages, we've got our dollar amounts. What's the thing we need next? Which is the fun stuff that I told you if you'd hang in with me for 3 days, we'd finally get to the fun stuff. Yeah, Morningstar. Sean knows this. How do we pick the individual assets? So let's ask the question, what makes a good mutual fund? First of all, why would we want to go mutual funds instead of buying individual assets? So a lot less risk. And can you have a diversified portfolio when you've only got $3,000 of individual assets when you've got $3,000 of total assets? The answer is no. In fact, most purchases of individual securities, it's $10 for purchase. And so if you buy $300 worth of an equity, let's see, $10 on $300, that's 3%. That's huge. So what we want to do is we want to buy mutual funds or ETFs, and we want to buy those mutual funds that will be around for 30 years. So when you're my age, 50 years, when you're my age, you can still be putting money into those. So how do we pick? What makes a good mutual fund? And so what I'll do is that's the assignment where I would like you to do is I would like you to think through the question, what makes a good mutual fund? Second thing, I'm going to divide you into 6 groups. About the first 3 seats going back, you guys are going to do international. Next 3 here, you're going to do real estate investment trust. This group here is going to do large cap. These groups here, we're going to do emerging markets. Next 3 here, we're going to do small cap. And then this last group here, we're going to do emergency fund. So you guys understand what your asset class is? And so on Thursday when I'm going to come, I'm going to ask that first group, give me the ticker symbol. And then what we're going to do is we're going to go and evaluate that. And so which security should I do today to give you the example? Should I do emerging markets because that's what I used to do for 13 years? Okay, so how do we pick an emerging markets fund? So what I'm going to do, first thing we're going to do is we're going to go Harold B. Lee Library. There's a teaching tool or learning tool called Learning Tool 7. So I'm just going to type Morningstar. Morningstar Investment Research Services. And so we're going to come here to funds. It says screen for funds. Now what we're doing is we're just going to use a database. And we're going to think through what are the things that are important for a mutual fund. And I'll just pick a few things there. So the first thing we're going to do is, let's come up here. We're going to come in fund category. And all of this information, instructions on how to do all of these asset classes are on Learning Tool 7. So fund category. Let's try it once more. You have to allow the pop-ups. Fund category. So what we're going to do, fund category equals international stock. And we're just going to say diversified emerging markets. So when I started, my 2-cent claim to fame is my partner and I started the first no-load open-ended mutual fund for emerging markets. When we started way back then, it was we were the first, and now there's 633. So what are some things that are important for us? So of these funds, what's important? How about, let's go fees and expenses. Do we want to make it a no-load fund? Because we control the costs. So let's say no-load funds equal yes.
Can you also put on their expense ratio? Like what expense ratio do you recommend?
Okay, let's do that one. So notice half of those emerging markets funds are no-load funds. So let's come here. Let's go to fees and expenses again. And let's do expense ratio is less than or equal to, let's just say category average. So we'll just take half of those, and we can adjust those later. Okay, what are some other things that are important? Hey, I have a question for you. You guys going to have a lot of money to put into these? How about a minimum purchase? Would that be an interesting one? Less than or equal to? Notice if you just put a value, it'll actually tell you. So the average first quartile is about 2,500. Some of these, you have to have 2.5 million or more. You guys will have to wait till next week to be able to invest in those. But for right now, what do we want to put our enter a value, minimum purchase? Okay, let's say 1,000. Okay, anything else? Now, let's take this. Do you want it to be an index fund? Does it have to be an index fund? Emerging markets, we could put that as an option. We're down to 85 funds. Let's look at this expense ratio. Category average, let's say 0.3. Now we're down to 4 funds. And you can adjust that, but let's just take a look. So we can actually go through here. Notice what the returns are. All funds are 4.29. S&P 500 is up 7.35%. Are emerging markets doing well or doing poorly right now? Actually not doing very well. So, and then what we can do is we can actually go through. Now, let me tell you something here. A signal fund is for an institutional account. So realize that that's a mistake, but Vanguard does do an emerging markets index funds. But let's just use this to kind of go through here. So we can actually see here's a style map. What is a style map? What's a style map? Thoughts? Anyone heard of investment styles? So you can giant, large cap, medium, small cap, micro cap, and then value, deep value, core growth, high, and that's really more balanced. So style is the way people invest. So these people here have large cap core. Would you like next year for them to be small cap core? Do you want them to change the asset class on you? Actually, no. So what you want to see is you want to see that style being consistent. And notice all these things. Here's the quote. Here's our allocation, stocks and bonds, 96% non-US stocks. Here's performance, how have they done? Here's the performance of the fund. Now I have a question for you. This is MISA EFA in US dollars. Is that a good benchmark for emerging markets? So here's the fund. Here's EFA, Europe, Australia, Far East. Does that make sense? This probably makes better sense. Plus or minus category, which are all the emerging markets fund. Number of funds, percent rank. Year to date, how are these guys doing year to date? Poorly. They're in the bottom 80. How about 1 year, 3 year, 5 year? So in the last 5 years, they're in the top 40%. But my point here is I want you guys to figure out what makes a good fund and how do you select that. So everyone has their assignment. You guys might want to work together, but on Thursday we're going to come up. I'm going to ask you to give me the ticker, and then we're going to evaluate it. So the challenge is to figure out what makes a good mutual fund, and then to apply that to Morningstar Fund. So if you do a good job, other people might be writing down that ticker so that they can include it in their portfolio. So kind of in summary, what have we talked about today? Number one, we talked about factors controlling investment returns. There's 6 factors controlling investment returns. 5 of them are the ones that you control, and 1 of them is outside your control. Successful investors work on the things that are within their control. We talked about the priority of money. What do we do first? Which investment vehicles do we use first? We talked about we want to get free money first. Second priority is tax-advantaged money, which is either tax eliminated or tax deferred. And the third priority is tax efficient and wise investment. We talked about how do you build a successful portfolio. And we went through, we start with our emergency fund. Our second stage is really our core, large cap assets. Third stage is diversify. And then our final stage is opportunistic. And what the bottom of the investment hourglass does is it allows us to put risk in perspective. The top allows us to keep our priorities in perspective. And then the bottom allows us to put our risk in perspective. And then we went through and we built a portfolio. And we said, okay, what's our emergency fund? How much do we have in that percentage in our emergency fund? We take the dollar amount divided by percentage, and that gives us an initial target portfolio. And once we have that, then we can calculate what our emergency fund is and what our core and what our diversify. And then once we did that, we showed how do we separate that between taxable and retirement. And the final thing we did is once you hit your target, then what you do is you increase your goal. And you kind of go through that same process. So investing is really not difficult. It's really a series of small goals that we use to reach our larger goals. Thanks, everyone.